Have you guys been keeping up with my videos? I just uploaded another Why You Should Build Your Agency With Us video. I've been getting a lot of play. I was talking to Andy Albright this morning, and he loves these videos. And he wants me to emphasize another thing. I'm going to redo another one. I got to get down to 3 minutes. And that's going to be hard to try to get the Alliance Advantage for building into 3 minutes. I'm going to try to do it. So maybe I'll try to do that tomorrow on my builder's call. I don't know how I'm going to do it, but I'm going to try. Like, here's the one that I did not remember to put in there that he pointed out. It's like, oh no. So let's say we're bringing on like a group from another company. Okay, so if you're with, let's say you're with American Amicable with another company, and they want to come over to us, well, you got to sit out from American Amicable for 6 months, or Mutual of Omaha, or CFG, or Foresters. You got to sit out for 6 months and not write it. And it's 6 months from the date of your last application, or 6 months from your contract date. If you never wrote business, the 6 month clock begins. So right after 6 months, you can recontract with that carrier through us, okay? Now, the thing with a group, let's say a guy, you bring or a gal comes over and she's got a team of 20 agents. While everyone's sitting out for 6 months, let's say with Mutual of Omaha, they can actually start recruiting agents with us right away, and they can hire people with Mutual of Omaha, and they will be able to earn overrides on all their agents, their new agents that are writing with Mutual of Omaha. They're going to be able to earn, even though they personally are sitting out from Mutual of Omaha, they can still earn overrides on Mutual of Omaha with new agents that they're bringing on. All their agents that are with Mutual of Omaha have to sit out the same 6 months. So they can continue building their business and still get paid on the company that they're sitting out for. And it's in there, but it's a combination of two things I mentioned in my video that you could do that. So this is sort of another strategy where you can actually bring on groups from those other 3-letter IMOs and bring them over to us. And they can't, you can't do it the other way. It doesn't work the other way with them. So anyway, it's another advantage. That's one thing I forgot to put in. So I don't know how I'm going to jam all that stuff into 3 minutes, but I need to jam it into 3 minutes. So anyway, all right. Well, I think I got people on here. Who got Tiffany, Scott, Lauren, Ken, Joy, George, my man George in New Jersey, Damian, Bruce, Anthony, Annette, Alton. All right, gang. So who's got questions for me? I do have something I'm going to share with you. It's more product oriented, but anybody have any questions?
Yeah, Alex, it's George. Can you hear me?
Yeah, hey George, I can hear you. Great.
All right. I have an applicant who he wants to apply for $500,000 of coverage, and if for some reason he just gets rated as a standard, not as a preferred, how easy is it to reduce that coverage down to $400,000?
Oh, that's easy. You just tell the so what happens is then you just tell the insurance company after they get the rating, hey, the client wants to change their application to $400,000.
Okay.
Yeah, so it's real simple.
All right, thanks.
Yeah, not a big deal. All right, that was easy. Anybody else? I had a really good call right before this one with Donna Phillips up in Cleveland. And she gave this lady was on 10 medications, and just like a lot of several diabetes medications, and the typical cholesterol and blood pressure stuff. And so I walked her through how to type in the medications into the CFG whole life quoting tool, and the answer came that she could only qualify for Advantage, the graded benefit program. But it was really cool talking her through how to do that. Then the answer was pretty clear. So she's going to call her client and tell her, hey, this is your rate. These are your rates. So that's why we teach that product, because it's a lot. They've got a lot more helpful tools than the other companies on determining, what program the client can get, because they have 3 different programs: Elite, which is the best rated program; Select, which is the next best rated program; and Advantage, which is a graded benefit program. So the question is, which one should I quote my client? Well, just type in the medications into the medication list and check them off, and then you'll find out which ones are eligible to quote. So that's why I like that product a lot. Is that split dollar program video on? Yeah, it's actually on the agent resources. So if you, let me show you that. So Damien asked about the split dollar video. My agent resources has like pretty much everything you can think of, everything and more. More than you ever wanted to know. So you go to abnfinancial.com. And then you go to more, go down to agent login, log in, and then the password is NAA rocks on. And split dollar, it's right here. These 2 chicks, the 2 split dollar chicks. Split dollar insurance basics. This is a real good program, man. Some business owners, you can make a lot of money on teaching business owners how to save money on taxes. It's pretty cool. So I was talking to a recruit yesterday about split dollar programs, because he specializes in group sales. And I said, man, you got a business owner? You need to talk to a business owner about split dollar, right? Okay, well, I mean, I'll just go over this while we're in this conversation. And then if you have questions, by all means, enter it in the chat box, because focus. Okay, so like split dollar, the split dollar program works great because it's a way for a client to shelter their taxes, right? So let's just take a scenario where let's say the business owner has $50,000 a year that is retained in his corporation, which would then, like, this is like, say, an S Corp. I think you do it with the C Corp. So the $50,000, he wants to not have to pay taxes today on those dollars. So let's say he's got $50,000 that he wants to shelter. So what you do is, so it's $50,000 per year. So if you can qualify for an index universal life, what you do is you put together an IUL where the premium is $50,000. So year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Go 50,000 every year into this IUL for 10 years. So that's $500,000 that he's put into it. And so you write an IUL. And so let's say, he's 45 years old. This could be a doctor. This could be a lawyer, okay? They're 45 years old. So the 50,000 comes out of the corporation in the form of a loan. Okay, so that 50,000 is not taxable to the corporation. Okay, so for the 10 years. And it's lent to himself, the employee, quote unquote employee, for 50,000 a year policy. And so let's say he's getting, I don't know, let's say, $7 million of life insurance. Okay. But what's happening here is the cash value grows. So his cash value account grows every year, grows. Okay. So at the end of 10 years, he's 55 years old, and this is on an increasing death benefit basis. He could have, say 15 million of life insurance, and then cash value, like a ton of cash value that is accumulated. And so let's say he waits another 5 years and lets this money percolate, lets this money grow. So at the end of 5 years, so when he's 60, so this is year 15, this cash value continues to grow every year for those 5 years. Okay, so at age 60, there's plenty of, there could be like, 15 million. Well, let's just say it's like 10 million. 10 million. Well, let's just say 10 million in cash value. Just where I haven't run the illustration, so I don't know. So 10 million. So he takes 500,000. 500,000 to pay off the loan. So that 500,000 comes back into his corporation as retained earnings. And then he's got to deal with the taxes at age 60 instead of paying taxes every year on that 50,000. Okay. And there are other things we can do with that 500,000, stick it in an annuity or do something with it. I mean, he's got to pay taxes on it. But all this time he's been saving taxes on it. Now, what's the tax implications over here? Well, there's a contract that the corporation sets up with himself, and it lays out the terms of 50,000 a year for 10 years, and then you can put an interest rate on it. Well, in the contract, you say it's a 0% interest rate. So why charge himself interest, okay? But the IRS, they put out rules as to if it's going to be a zero interest loan, then we're going to tell you that we believe the economic value to you is 1%. So we want you to pay taxes on the economic value of 1% of 50,000. Okay, so on his personal tax rate of 37%, for example, we believe that that $50,000 loan, your economic value times 1% is $500. Okay, so we're going to say that you had an economic benefit of $500. We want you to pay your 37% tax bracket. We want you to pay taxes on $500. Okay, so you see how that works? Pays no corporate taxes. His only personal tax is on the imputed interest rate of 1%. Okay, so then year 2, he's got the loan of 100,000, right? $100,000 loan times 1%. He's got to pay taxes on $1,000, right? And then the next year it's 150,000. The next year he's got to pay taxes on 1% of 150,000. He paid taxes on $1,500 on down the road. So it makes it fair and square with the IRS, right? But check out the value that he's getting, because then he activates after he pays his loan off. Then let's say he's got 200,000 of tax-free retirement coming in at age 61 when he activated for the rest of his life. 200,000 tax-free. Again, I don't have the illustration, but this is how it works. And all he did was pay the taxes on the imputed interest through 10 years, and then lets the policy grow. Then he pulls the money out, 500,000, to pay it off, and then he deals with the taxes here at a corporate tax rate instead of here a personal tax rate. You see how cool this is? And by letting this money sit out of taxation, he creates a lifetime income. He's got $10 million of life insurance. And then the money goes back to him in his corporation. So where did he lose here? Like, where did he lose money? It's in a safety vehicle that grows at an index rate, tax-free, and then he's able to get life insurance. So when he dies, if he dies in the middle of any of this, his family gets a massive life insurance policy. And then if he doesn't die, when he turns 61, he can start drawing. Well, when he turns 60, he pays himself back the loan, which is 500,000, right? And then your commissions on first year, you know, let's say that the target premium on this was, you know, 30,000 target premiums, which you get paid on. And, you know, if you're on a, I don't care, whatever, say 30,000 times 0.85. So you're going to get a commission check for $25,500 for this policy, but then you get your renewals on 50,000. So that could be another, I don't know, $1,500 in renewals over the next 9 years, because it's 50,000 for 10 years. Or it could be 50,000 for 15. You know, just depends on how much money when he decides to retire. Okay, he can still keep sheltering money in there, and all this goes up. See, is this cool or what? I mean, split dollar, man. Split dollar is where it's at. And you know, even if a business owner had 25,000 extra a year, that's a $2,000 a month IUL. You know, the target premium might. What I'm saying is, you can you imagine getting commission on 25 grand on a split dollar program? And this has nothing to do with premium financing. We can do premium financing on this, and it could be way more that you can get commission on, because, you know, 50,000. If he's got 50,000 a year, he does premium financing, then you're looking at maybe $100,000, $150,000 annual premium policy with borrowed money, and you get paid on all of that. Okay, even though it's borrowed from a bank. Anyway, so split dollar rocks, man. I'm a big fan of split dollar. So I have a video that kind of goes into exactly what I just did. So if you know any business owners that want to shelter money, you know, if they're a sole proprietor, they need to have a corporation, a corporate entity, like preferably an S Corp. So that's my little commercial on it. Anyone got any questions? Any sales questions? Any product questions? I don't know that much on. I do a little bit on product.
Alex,
Yeah.
When do you bring up return of premium, or do you always, or sometimes, or when is it good to talk about that?
I don't know. That's a good question. You know, it's just kind of funny how return of premium used to be. We used to sell 70% of our term policies back when I got started had return of premium on it, because return of premium is so cheap. You know, the problem today is that return of premium is expensive. And I don't know, it just depends. It depends on the client you're sitting down with. Like if they, you know, if you can tell that they're living hand to mouth, I don't even mention return of premium. You know, if you find that they're a little more sophisticated couple, they're college educated and making some money, then I might be talking to them about an IUL. You know, that niche of return of premium is the conversation when, as you're talking to the client, you can tell they have some means, right? This is the Vinny conversation, talking to a client about term versus permanent insurance, where really the return of premium is sort of a kind of you're standing in the middle. Okay, so if your client has some means, again, I go for the IUL all day long, but this is sort of that in between client. Then the conversation before you start laying out options is educating them on term. Like, Joe, now I just want to make sure you understand, like the program that we're going to be talking about is a term mortgage protection program. And do you understand what term insurance is? And a lot say, well, yeah, I kind of do. I kind of do, but explain it to me, Well, term insurance is like renting an apartment, okay? In other words, you're renting your policy for, let's say, 20 years. Okay, you're renting your policy for 20 years. And then after 20 years, if you're not dead, the policy stops. And then all that, let's say you put $15,000 in that policy over the next 20 years, you rented your policy. So then at the end, there's nothing, you get nothing back. So it's kind of like your auto insurance, right? Your auto insurance, they don't ever give you any money back, but you got to keep paying. That's how term insurance works. Does that make sense? Yeah, it makes sense. Now, let me ask you, does the prospect of paying all that money into a term insurance policy and then not getting anything back, are you okay with that? Does that bother you at all? Or are you okay with that? And this is where they tell you they're okay with it. No, that's fine. Whatever. If they say, well, I don't know if I like that. Oh, okay. Well, would you like me to show you how you can build equity into your policy so it gains a value when you end it? With that, it's kind of like buying a house. Like you obviously bought a house. Why did you buy a house versus continue to rent your house or apartment? So you ask them a question. Well, I didn't see any reason why I would be throwing my money away at rent. Exactly. So I think you're getting the concept, aren't you? Well, yeah, I think so. So would you like me to show you an alternative to the renting mode, the renting thing? And then they say, well, yeah, sure. Okay, well, there's two things that we can do. We can set you up in a program that you can pay like maybe 25, 30% more per month, but at the end, you get all your premiums that you paid into it back. So let's say instead of a $15,000 at the end of 20 years that you put into a regular renting type program like term insurance, let's say it costs you maybe say 25,000, let's just pick a number, 25,000 over those 20 years. But at the end of 20 years, you get that $25,000 back in a lump sum tax-free. How's that sound to you? Well, that sounds a lot better. So I'll be paying more per month? Yeah, you'll be paying more per month. And then if you die any of those 20 years, your family gets the death benefit so they can pay the house off, okay? But if you don't die, which you don't plan on dying, do you? Oh, no. Well, at the end of 20 years, you get that whole $25,000 back. So look at it this way. The other program, you put $15,000 in over 20 years, and that $15,000, poof, goes up in smoke. Or you can put $25,000 total that 20 years, and you get $25,000 back, tax-free in a lump sum. So which sounds better for you? I like that. I like that better. Okay, great. Well, let me run some quotes for you then. Now you can push it, you can go to the third option. It's like, now the third option is, I can set you up in a program where instead of getting that full amount back, you put a little bit more money into it, this policy, and it's exactly like buying a home. You can earn equity into it, that can be more than what you paid into it over time. And it's something you can keep the rest of your life and continue to build equity into this policy where you, at some point down the road, you can take that money out tax-free and it grows at an interest rate. And it can be really the basis to augment your retirement. So it can be more than just a term policy and more. Now, you'll have, plus you have insurance the rest of your life. So you have insurance the rest of your life. You can build equity in a policy where the money that grows can be more than what you put in, much more, substantially more, twice what you put in, 3 times what you put in. Then you can take that money tax-free in retirement. You know, now that might be a little bit more per month, but aren't you happy that you're paying a little bit more per month to buy your house than paying less per month and renting an apartment, right? So you take them through the decision process by offering up the solution to the problem. The problem is paying money into a policy and not getting anything out of it. So I always try to make sure that they understand the problem. That they may not know it's a problem, but how you explain it to them, they realize, oh, wow, I get nothing back at the end of 20 years? Yeah, you get nothing back. Are you all right with that? You sip your water, let them chew on that for a while. No, I don't like that. Every question's a setup, man. Every question you ask a client is setting them up for the next thing, setting up for the next question, and the next question, and the next question. And then you start walking them down the road. Now, here's another thing that we did with return of premium that we sold a ton of these. And I'd have to run the numbers to see if it makes the same sense. But it was called our mortgage cancellation strategy. Okay, focus. Oh, come on, man. It's the mortgage cancellation strategy. Follow me. Oh, come on. You're not going to do this to me, are you? Hold on. I don't know why I have to keep doing this. There we go. Okay, so back in the old days when when the finances, well, the way they priced return of premium, I don't know if we could do it today because I think that the return of premium on this worked with 100% return of premium. The return of premium on Mutual of Omaha's Term Life Express, I think it only can be done on a 30-year term. So that I don't think that would work. But just conceptually, what we do is instead of doing a okay, so here's someone's. Oh, come on, man. Let me get a fresh marker. Okay, so this is the amortization schedule on a mortgage. Let's say the mortgage is $150,000. Okay, year 10, 20, and 30. 10, 20. Oh, I kind of drew it out. So the 20-year point on a 30-year amortization, you'll have about $75,000 left to pay the house off. That's just, if you ever ran amortization schedules, this roughly is what would happen, okay? And so what you do is, we used to write 30-year return of premium, but, we'd say, here's a great strategy, Joe. Instead of a 30-year return of premium, let's do a 20-year return of premium. Okay. Now the premium on 20-year return of premium, you know, on a 30-year return of premium program, I'm just trying to remember, you know, let's say this was $150 a month. On a 20-year return of premium, let's say it's $225 a month. Okay. $225 a month. It would go up dramatically. And so at the end of 20, you know, let's say it was like $70,000 return of premium. This is really kind of how it worked. You know, here, you know, the return of premium would be much lower. It'd be like, say, 50,000. Okay. So we would convince them that then the 70,000, let's say they're paying, you know, $1,000 a month for their mortgage. So they take the 70,000 at the end of year 20, they cancel their mortgage. Okay. So this is how we'd explain it to them. Do you know what the value of this is? Oh, what do you mean? Well, first of all, during this 20 year, you got coverage. So you're going to get $70,000 back. So that's the value of doing this here, year 20. But here's the other thing. You cancel the rest of your mortgage. So your mortgage is 1,000 times 12 is 12,000 a year times 10 years is 120,000, gets canceled. So let's add another 120,000. So that's 190,000 benefit to you by putting in $225 a month in your program versus 150, versus 30-year no return of premium, which is 100. Okay, so now tell me, how would you like to have the economic benefit, 190,000, by canceling 10 years of your mortgage for $225 a month? Bam, we would close the snot out of these, and we get paid on $225 a month, not at 150 or 100. Like, we literally doubled our commissions, and it rocked, man. We were selling a ton of these strategies, a ton of these strategies. Okay. The only problem is you have to look at the products that we have today. I don't think, like, we have 50% return of premium. That doesn't really quite get us there. But you can structure a UL product, like a smart UL, to do exactly this right here. You can structure a UL to pay off half the mortgage in 20 years from a 30-year mortgage, right? So the only way you could do this is with a UL. And you can construct a UL to do this. I think Americo has a return of premium option that Andy was telling me that you can do it 25 years early. So it's a 25-year payoff. So you save, you know, instead of 120, you can save them 60,000 on 5 years of mortgage payments, run a 25 return of premium program, right? And it's going to be more per month than they have enough to pay off the last 5 years, okay? But I think you could spin a UL to do exactly the same thing to pay the mortgage off, because all you're doing is getting the UL cash value to get up to, you know, half the mortgage, like 75,000 cash value in 20 years. Okay, then you just pull the money out and pay it off. Yeah. And then you save them all that money, right? So, but you got to be good at running UL illustrations, you know, just to make sure that that you can do it. In fact, so anyway, Damien asks, can you do a split dollar on a 58-year-old? Okay, you can do 58-year-old. The thing with IULs for tax-free retirement, okay, is you need 15 years. You really need 15 years. So if they're good at taking their money out when they're 73, then yeah. And you know, a lot of these people are thinking, you know, I'm going to be working anyway till I'm 70. You know, they're already thinking they're going to be retiring, plus our life expectancy is going up. So that's the kind of the rule of thumb is, do they have 15 years to do the strategy? And if they do, then we can run an illustration on them. Okay, does that make sense? So now you guys got me on a roll here, since no one's asking questions. Let me see if I can fire up my Forrester Smart UL. And Smart UL may not be the right product, but because it's a UL and because the it's a lower interest rate, if it works with Smart UL, it'll definitely work with the other ULs. Let me see if I can find it. Wow, I'm surprised I don't have Foresters on this computer. This is my Mondo computer. Now, let me see if I can pull it up. Oh, that's weird. What time is it? I did that with F&G. They had the best return. Yeah. They have the best projected return, so you can do it with F&G Live for sure. We actually can do that with F&G. Let me see if I can. Oh, God. I don't know why this is giving me issues. I'm just in it. Are you guys having issues getting into the ARC? What is up with this? Golly, that took like an act of God to get in. Okay, so I'm trying to. Okay, I'm in Foresters at least. I couldn't get an F&G. It's really weird that it's like that. Oh my gosh. Now it's asked me to reset my password. I don't think this is happening. Oh, unbelievable. I'm going to tear someone's head off. Let me see what I have on my computer. Oh, there it is. I do have it on my computer, but it's probably going to ask me to update the interest rates. Okay, just bear with me. Jeez. Okay, I'm gonna see if I can just run it with this. So let's say you have a 45-year-old and okay. Let's say their house is 200,000. Say 200,000 life insurance. Okay, so let's just run it at just the default values as far as how much money you're putting in. So let's go at a glance. And so it's got $200,000 mortgage, 20 years, it'll be 100,000 payoff. So our objective is get to 100,000 cash value. In 20 years. Okay, so you can see here that it's only got 51,000. Okay, so we're gonna have to amp it up. Okay, so let's specify premium. This is what 240. 240 is the premium. So let's see if we can put in let's put 500. See if it'll let us put 500 a month in. Okay, and hit at a glance. That might be too much for the 200,000, but we'll see. So 500 bucks a month. Yeah, it's too much. 69,000. So see if we can get increasing death benefit. Let's go increasing from year 1 to year 10. So this is increasing death benefit. Oh, geez. Okay, maybe I got to do year 20. Oh, we can increase the death benefit. Say 300. Okay, so that's kind of close. And they wouldn't let me put, yeah, so I need a little bit, I need a little more room here. Let me see, now I'm getting, the perfectionist in me is getting a little bit. Golly, it won't let me. Oh, I know what it's doing. This is so dumb. Dummy. Yeah, see all this UL software. Oh wow, he rocks the cash value, man. 127,000. Actually, this scenario is really cool because look, he He puts in 500 a month. That's 6,000 a year. He put in 120 grand, and he gets out 127,000, more than enough to pay the house off. So he gets the 127,000 back, plus he cancels out like on a 200, let's say it's 1,500 a month, 1,500 a month times 12 times 10. So you had 180,000 value plus 127,722 to 307,000 return on that 500 bucks a month at the end of 20 years. His house is paid off, and he's had 300,000 of life insurance all through that period of time for 500. So let's say if we, now I want to start playing with this. So if we went back to, let's say 200, let's bring it down. Let's see if that, $114. So he put like 93,000 because it drops off, this premiums drop off. So let's see if we specify. Oops. Oh, it should be like maybe 400. You're 20. Okay, so now it's got 102,000. He put in 90,000, and it's 400 bucks a month. And then, it tails off here. The premium drops because you can't put, well, the premium drops because his amount of insurance, well, his amount of insurance got level here. That's actually pretty cool. Now, if you can tell him now, look, if you want to continue to keep this policy in force, so he's got options, in other words. So if he doesn't want to pay it off, he doesn't have to. He just keep going. But you see how this, you can start playing with the UL illustrations, and then you're getting paid on 40 target premium, a higher target premium, which in this case, if you sold this, I mean, it's not always about how much you're going to make, but by being smart and giving them a solution. What's target? Oh, wow. I know in a printed out illustration on a report, it'll give me target. So let me see what that looks like. I know in here there's a target premium, and that's what you get paid on. Oh, by the way, this has all the living benefits, etc. Doggone it. Target premium's in here somewhere. It's probably at the end. Oh, now this is driving me crazy. I know it's got to be in here somewhere. I know in the other illustrations. Anyway, so does that make sense? This is a little bit more, insurance, 404. But you can spin a return, because we don't have the kind of return of premium options that we had back in the day prior to when the insurance companies were the insurance commissioners to cover return of premium. They wanted insurance companies to put more money in reserves. And so when that happened, the price for return of premium options went up. And then some companies just did away with the 100% return of premium, like CFG, and just did 50%, just to keep the costs down. And, because no one likes to keep, insurance companies don't like to keep money in reserves, because that's required by the insurance commissioner. All right, so that's a little bit nerdy, a little bit insurance nerdy. But look, I mean, you really understand UL and understand how to run illustrations. You can craft some pretty ingenious opportunities for your clients to get into something that's a high value product to them. But again, you gotta be smart at running the scenarios. Does that make sense, gang? All right, we are coming up on, so any other sales type questions that y'all have? For those of you that took advantage of the lead discount, I expect to see some leads coming in probably tomorrow, the initial set of leads to come in tomorrow. And then I will get those out to you guys and gals as soon as I get them, okay? Any questions? All right. Well, that was a fun session. Anyway, gang, thanks for plugging in. I hope this helped out, give you a little bit more of a vision as far as what you can accomplish with these great tools. You can be the insurance Superman, Superwoman, if you want, and then supercharge your commissions. All right, man, rock on, everybody. God bless.